Let's talk about the secrets to job interviews. In fact, I'm going to tell you 2 secrets. Number 1, the job interview is not about what the company can do for you. It's about what you can do for the company. What's the goal of financial management? Maximize shareholder wealth. I'm a manager at Halliburton at the time, and I'm actually in the management program. I'm interviewing a guy that I actually went to undergrad with. He stuck around to get a master's degree. I did not. And so now he's interviewing for this program. And I said, so what makes you interested in Halliburton? And this guy who looked kind of like me, only like better looking, but he's a white dude. And he says, well, I see you have operations in West Africa. I said, yeah. He said, would it be possible for me to end up in West Africa? I said, yeah. I said, we've already sent at least one person out of our program to Nigeria. And I said, we can send people to Angola too. I said, that's great. I said, what do you want? Just curious, why do you want to go to West Africa? He says, I want to be a missionary. I said, that's great. Now, do you think Halliburton was interested in sending this guy to Africa for him to become a missionary? No. If I'm sending you to West Africa, I'm sending you there to maximize shareholder wealth. Right? Does that make sense? So it's not about what the company can do for you, it's about what you can do for the company. Now, the second thing that I'm going to tell you is that an interview is a 2-way street. A lot of times students think that it's just all about the company finding out about me, but I also want to be finding out about them. And so ask questions and listen carefully to the answers. And here's the most important thing. Have your asshole radar on and the sensitivity turned to high. Because unless you are starving to death, dead broke, it's better to be unemployed than to work with assholes. I spent 15 months with a company one time because I ignored that radar, and I was absolutely right. My radar was absolutely right. In other words, we'll say trust your gut, right? If you think these people are a bunch of jerks, they probably are. Questions? Okay, let's get back to where we were. We were talking about strategic plan, and we had got down to talking about managers deciding which new products to introduce. Remember, marketing has gone out there and told us what's there a demand for in the market, and we've already kind of got down to, well, can we cost effectively make this? What kind of money could we sell it for? That sort of thing. And so now, using all that information, the managers are going to decide what new products to introduce and which existing ones need to have their production curtailed. And I'll give you an example of that here in a little bit. Now, this increased sales might require increased assets. So let's assume that we're running at full capacity. Full capacity means that I cannot make one more single unit without building more factory or buying another machine. And so that's full capacity. If we're running at full capacity, if we increase sales, we know for sure we're going to have more assets to produce those goods or services. Okay, now, here's my example. The example comes from a company called Americhem. I worked for them back in the early 2000s, last company that I worked for. And we made this little plastic pellets that I've told you about before. So, here was the discussion. Marketing started out by identifying the areas for growth. And at that time, that was the beginning of the SUV boom. Most of you have probably grown up with SUVs being the most popular vehicles around. It didn't used to be the case. It used to be the four-door sedan. It was very boring. Anyway, but the SUV boom is starting to take off. The first people to build SUVs are the Americans, and American car companies were our customers. We made the colors that went into the dashboards and those doors and whatnot. So that was all our stuff. And so this upcoming SUV boom, we knew that we were going to have increased demand from our automotive customers, and therefore we needed to scale up our production. So that's an area where sales was going to increase, and we need to increase our production. At the same time, we were making polyvinyl chloride products, so PVC. You know, like those white pipes that you see, that's PVC. But PVC is also used in other things. These water bottles you guys drink from, 20 years ago, those would have been made out of PVC. Here's what you need to know about PVC. In order to work with it, you have to put something in it called a plasticizer. Otherwise, it's very brittle and it just shatters. And so how do we make this stuff work? We put these plasticizers in it. And it turns out that those plasticizers would leach out into the water that the people were drinking, and you might still not be a problem except for one thing. Those plasticizers were what we call estrogen mimics. What is estrogen? It's a female hormone specifically, right? Now, how did they figure out that there was this problem? Dudes started developing breasts. Some people might be into that, but from a food and drug perspective and a food safety perspective, we couldn't do that. And so there was this basically a whole section of the PVC market that was totally decimated. And so we knew that our sales of those products going forward were going to be down. Now, was PVC totally dead? No, we still had vinyl siding, we still had pipes and stuff like that, but we certainly no longer had all the pretty little different colors, which was our big business, that went into these water bottles. By the way, you look around, you can see, look, I can see at least 7 or 8 different colors of water bottles here, so we had all sorts of fun colors. Okay, now, when we talked about what we needed to do, it turned out that the machinery that we were using to make those PVC, we'll call them packaging or beverage bottle colors, could actually be repurposed to do the automotive stuff. And so we were actually able to, because they were just extruders, we were able to take these extruders and put them onto this new sale product. But it wasn't going to be quite enough, so we had to go out and buy, I think, 1 or 2 additional extruders. Those would be the additional assets that we would need. Now, if you can actually identify down to the machine what you need, then you can identify the amount of new assets. But oftentimes, when we're doing this kind of thing, instead what we do is we just assume that the assets grow at the same rate as sales. We just assume that the assets grow at the same rate of sales. Now, is it necessary, or is it necessarily a good assumption? And the answer is probably not. Probably not. But you've got to start somewhere. By the way, when I'm teaching you about long-term financial planning, you're going to think it's very complex and difficult, but in fact, I am simplifying it terribly. And I'll talk to you about where we made simplifications as we go along. And that first one is that the assets grow at the same rate as sales. So the financial plan is going to follow a strategic plan. We have figured out we need these new assets. Now the question is, where do we get the money? And there are basically 3 ways that a company can pay for new assets. Number 1 would be internal equity. Where does internal equity come from? Yeah, it's previous addition retained earnings is our accumulated retained earnings. That's internal equity. Very good. If we have made money in the past and we have not paid it out as dividends, then we could use that money to invest in new assets. That's internal equity. And then there is external equity. External equity. Mr. Long, where would we get external equity?
Like raising money.
Raising money, and what would we do?
Either ask shareholders or issue new stocks.
Yeah, so it's basically you're going to have to issue new shares. You're going to have to issue new shares. So we've got internal equity, we've got external equity, and then we have debt. Now you need to understand that all debt is external. I was given this talk one time, and this guy in the class worked for SRC. Do you guys know what SRC is? It's Springfield Remanufacturing, something like that. Anyway, it's a conglomerate, and basically they've got this holding company, and they own all these little businesses. And the trick is that if it makes money and it's legal, SRC is interested, right? So they've got all sorts of weird different businesses. Now, the problem is this. These little weird different businesses, they send money back up to the mothership, the holding company, and then the holding company will actually loan the money back to the different subdivisions of the firm. And my students said, well, wait a minute, isn't that internal debt? And the answer is no. That is actually internal equity that the holding company is flashing back to you as debt. Or the holding company went outside and issued bonds externally, and then they're able to turn around and loan that money out to the individual, I know subdivision isn't the right word, but you know, the individual companies that are comprising the firm. So, all debt is external. If you don't believe anything else I say today, believe that all debt is external. Any questions so far? Okay, now we know we need new assets, so we know we're going to need a certain amount of money. The question now is, how do I divvy up that money from these different sources? So this is a very, very simple financial planning model. And the first thing is we start with the sales growth from the strategic plan. And in fact, that's a great test question. Where does the financial plan begin? It begins with the sales growth from the strategic plan, because that sales growth is going to determine the asset growth. We assume that our assets are currently at full capacity. Now I'm going to relax that assumption later. I'll show you how to deal with that. For right now, we assume we're at full capacity. And we're going to assume that the assets grow at the same rate as sales. Now, is that necessarily the best assumption? And the answer is no. Let's assume that we have 4 factories right now, 4 identical factories, and they're all at full capacity. And our sales growth forecast is for 10%. Can I build, or can I, what do I do with assets in that perspective? I have to basically go build a new factory, right? And so my assets are going to increase by 25%. Now, why would I go out and build a 25% factory that's only going to have 10% in it? What do we assume is going to happen down the road? More growth, right? When you first build a car factory, do you think it's full capacity the first day? No. Okay, so we're going to assume, though, that the assets grow at the same rate as sales, even though that's not necessarily the best assumption. And we're going to use that assumption to determine the new level of assets that are needed to support our new level of sales. And so that's going to mean that we have to increase our assets by a certain amount. Okay, now we are going to figure out what is the addition to retained earnings in our new scenario. That is our internal equity that's being generated from this new level of sales. And we're also going to have to figure out our external financing needed, EFN. Basically, we're just going to assume that we're going to use the internal equity and everything else has to come from outside. Now, what did I say the 2 external sources were? There's external debt and external equity, shares, right? Okay, so basically now we're just going to have to figure out where are those external funds going to come from. And that's what the last bullet point is about. Now, how are we going to decide how these things break down? Well, we're going to be given some directives, some constraints, and they're going to show us how we need to break it down between those categories. So here we have the world's simplest income statement and the world's simplest balance sheet. And on our income statement, we see we've got sales of 1,000, costs of 800. By the way, costs includes all your costs, including your taxes and everything else that we would subtract out there, leaving us with a net income of 200. Now, I want you to notice here that the dividends and the addition to retained earnings add together to equal the net income. Is that a coincidence? No, that's always the case. So let's write that up here. Net income is equal to the addition to retained earnings plus dividends. And so we could actually rearrange that and say the addition to retained earnings is just going to be the net income minus the dividends. And remember, we're trying to figure out what that additional retained earnings is because that is our internal equity. Okay. Now, they also tell us that we have 500 in assets and 250 in debt and 250 in equity. Now, if you add those two together, it equals 500. Is it a coincidence that that's the same as the total assets? No, the balance sheet equation tells us that assets is equal to liabilities plus owner's equity. It has to be that way, otherwise it's an unbalanced sheet, and we don't allow those in accounting. And then we have the final thing that we need to get started, and that is the forecasted sales growth for next year. So we can start figuring out what's going to happen in the next year. The first thing I'm going to do is multiply my sales by 1.2. Why did I multiply by 1.2? And so it's a 20% increase over previously, right? So we're running at 120%. 120% divided by 100% is 1.2. And so we multiply by 1.2, and that gives us our new sales of 1,200. Now, we have to make another assumption here, and that is a constant profit margin. And if we assume a constant profit margin, it means our costs are going to increase at the same rate of sales, and our net income is going to increase at the same rate as sales. Now, I'm going to tell you that's probably not the case, and here's why. Think about cost. There are really two kinds of costs. We have fixed costs and we have variable costs. What we're doing right here assumes everything is variable cost. We know that's not true. So this is kind of a worst case assumption for costs. Typically, as your sales grow, your fixed costs might stay similar, but your variable costs will go, or your total variable costs will go up because of the number of units. Okay, so we're going to take 800 times 1.2, and that's going to give us 960. So that's our new cost. Now, we can come to our new net income figure in one of two ways. Number one, I can either take 1,200 minus 960 and get to 240, or I can take the original number of 200, multiply by 1.2, and that gets me to the same 240. And if you don't get the same number going from both methods, you've done something wrong. Okay, now notice that at this point, we don't say anything about dividends or addition to retained earnings. We haven't been told anything about the payout policy of the firm. Was the policy to pay out 50% of its net income in dividends? Or was the policy simply to pay out, 100, right? We don't know. We're going to have to get some more information on that. Okay. Now let's talk about the balance sheet. We said that we're going to make the assumption that the assets grow at the same rate as sales. Sales are growing at 20%. Therefore, our assets will grow by 20%. So we're going to multiply our original asset number by 1.2, and that brings us up to 600. But do you see a problem with our balance sheet now? It's no longer in balance. It's no longer in balance. We're going to have some more debt and equity in order to make this thing work. And so the next step is to figure out that debt plus equity is going to have to equal 600. We know that. It has to. It has to equal 600. Now, we haven't been told yet, except for we finally have been told here our first constraint. And that is that we're going to grow while maintaining a constant debt-to-equity ratio. Previously, we had 250 in debt and 250 in equity. What was our debt-to-equity ratio? 1. And so when we get done here, our new debt-to-equity ratio has to be 1. A couple of ways we can go about that. If we have a constant debt-to-equity ratio, it's easy enough just to multiply by that same 1.2 that we've been doing. That'll get you there. The other thing is to know that we need two identical numbers that add to 600. What are two identical numbers that add to 600? 300. So either way, it's going to give us that our debt and equity must be 300. Okay. Any questions so far? Okay, now we have been told we know what the new debt and equity are, and we know that each one of those are going to have to go up by 50, because 300 minus 250 is 50. Where am I going to get the debt? Internal or external? Yeah, it's got to be external, right? And so we already know we're going to need at least 50 in external financing needed. Now, the question is, where am I going to get the equity? How? Yeah, we can do retained earnings. In fact, we can look at our net income. Our net income is 240. Is our net income enough to cover that equity that we need? Yeah, it's more than enough, right? And we also know that net income has got to be equal to addition to retained earnings plus dividends. Well, if we know this number is 240, and we know this number is going to be 50, then we can do a little bit of math and figure out that our dividends have to be 190. They have to be, or this doesn't work out. They have to be, or the math doesn't work out. We call dividends here the plug variable. We call dividends here the plug variable. Plug variable, it's not important for you to find the plug variable, but the purpose of the plug variable, it's the thing that we let float to make the math come out. And you'll see later on that we'll have other plug variables. Now, this is something that, you remember, I think I've told you previously that politicians are typically lawyers, and lawyers are typically smart people who can't do math. And these laws that they pass, where they try to constrain everything possible, it doesn't work. You've always got to let something float in order for things to work out. And that thing that we let float in this problem is the plug variable, and there may actually be more than one. Okay, so for this example, if I ask you, what is external financing needed, you would say 50, and that 50 is going to be in debt. So far, so good? Okay. Now, we have been given example 2 here, and it is to grow while paying out no dividend. Grow while paying out no dividend. So if dividends are 0, what does that mean about the relationship between net income and addition to retained earnings? Yeah, everything is going to be flowing into that addition to retained earnings. And so that means the internal equity that we're going to be adding on here is going to be how much? 240, right? We're going to be adding 240. So our equity is then going to become 490, because 250 plus 240 is 490. Now, once again, we know that assets plus liabilities, assets minus liabilities has to equal owner's equity. What happens here? How can I figure out debt? Can anyone tell me how to calculate the debt? Yeah, assets minus the equity gives us the debt. In this case, the debt has to be 110. The debt has to be 110. In this case, what's the plug variable? Debt. It's the thing we're letting float, right? Okay, now, my next question is this. How do I get debt to go down from 250 to 110? You owe 250, you want to only owe 110. What must you do? Yeah, you've got to pay off, what, 140? Now, if we are paying off external debt, and all debt's external, that means the external financing needed for this is actually negative. It's actually negative.
And what debt
Say again?
Convert debt into equity?
Oh, convert debt into equity. Well, no. We are going to, so we've got this money coming in, right? We got 240 coming in. How much of that do we actually, so that brings us up to 490 on the equity, right? We only need 600 in assets. So we're going to have to pay down the debt. If I don't pay down the debt, by the way, the cash came from doing business, right? That 240 that came in, that's where the cash came from to pay down this debt. So if I don't pay down that debt, what's going to happen here? Now we'll know if we don't pay down the debt, we'll have 250 plus 490, we would have 740. Do we need 740? No, we only need 600 in real assets. We should have debt plus equity equal to 600. That's why I've got to pay that debt down, and the cash comes from us bringing in the cash from the business. Does that help? You look unconvinced. If you want to come by my office later and talk about it, we can. Okay. Now, here's a new one. Can grow while maintaining a constant dividend payout ratio. So far, we have been only having one constraint at a time, and that makes life easier to only have one constraint at a time, which is why I have one wife and no kids, right? Only one constraint at a time. Okay. So, what's the dividend payout ratio? What was it previously? By the way, dividend payout ratio? It's just equal to dividends divided by net income. So previously we had 100 in dividends and we had 200 in net income. And so our dividend payout ratio was 0.5. So we're paying out half of our net income as dividends. Now what happens if we say, well, going forward, we want to maintain that same dividend payout ratio? Our dividends now have to be 120 because our net income is now going to be 240. And so we're still basically taking half of the net income. All I do is take this payout ratio and multiply it by the new net income, and that gives me the new level of dividends. Once I know the new level of dividends and I already know the net income, what can I calculate? Yeah, the addition to retained earnings, and that is our new equity. So that's going to get added on to the 250 that's already in equity and bring us up to 370. Now, if I've got 370 in equity and I need 600 total assets, what must my debt be? Yeah, 230. It's got to be 230 because 230 plus 370 is 600. Now, if the debt was initially 250 and now the debt needs to be 230, what must we do? Yeah, we're going to pay down our debt by how much? 20. And that is external financing, but it's in the opposite direction. So our external financing needed here is minus 20. So we're going to see 20 in cash flowing out of the firm. What was our debt this time? Or what? Sorry, what was our plug variable this time? Yeah, it was debt once again. Now, a lot of students get freaked out thinking that when we pay out that 20, that now our assets are only going to be 580, and in fact they're wrong. What would happen is if we didn't pay out that 20 in cash, our total assets would rise from 600 to 620, and that extra 20 would be in cash. So we have to pay that money out or our assets will actually go up. I can prove it to you. What is 370 plus 250? 620, right? We only need 600. By the way, are the shareholders thrilled for us to sit on hoards of cash? No. Who does the money belong to? shareholders, and if we don't have a good project to invest it in, what should we do? Return it to the shareholders. It's their money, right? Okay. Any questions so far? Oh, wow, now we're up to two constraints. We're going to pay a set dividend and maintain a constant debt-to-equity ratio. It's getting kind of hairy. Okay, the set dividend that they tell us we have to pay is $200. If my net income is $240 and I'm having to pay out dividends of $200, how much is my addition to retained earnings? 40. Yeah, it's got to be 40. And where is that 40 going to get added on to? Yeah, it's going to get added on to the equity. Now, here's the freaky thing. That's going to bring us up from what, 250 up to 290. But we know we've got to maintain a constant debt to equity ratio. And we know that means that the debt has to be 300 and the equity has to be 300. Internal equity is only going to get me up to 290. What do I have to do? Yeah, I've got to issue shares in what amount? 10. Yeah, we got to issue 10 in new shares. And so far we've got 10 in external financing needed from equity, but what must also happen to the debt? Debt's got to rise from 250 up to 300. I've got to go outside and borrow how much? 50. And so what's my total external financing needed under this scenario? 60. Yeah, it's 60. It's 10 in equity and 50 in debt. Does this stuff look easy to you? It's not. It's not. And I guarantee you that the best bet for you would be to go back and either watch my video or Mr. Warren could listen to his recording. I bet you got a better microphone than I do too, right? Okay, go back and listen to the recording and walk through this and make sure you understand it, because there is a boatload of mental gymnastics going on here. Have you guys noticed that? So it's so amazing when I give students a problem and they're like, well, it took more than one step to solve. I'm like, yeah. They're like, that's not fair. I say, well, apparently life's not fair because life is full of multi-step problems, right? Okay. Now, earlier I said we're going to make the assumption that we're running at full capacity. And I told you that we would relax that assumption and I would show you how to handle that. So now we're going to assume that we are running at 90% of full capacity, and that when we get done, we want to be running at 100% full capacity. So that's the assumption here. Now what does that mean if we're running at 90% of full capacity? So go ahead.
Oh, no, you're good.
Okay, yeah, I was going to tell you, but if you'll tell me.
No, I don't know. You know this.
By the way, I'm digging your socks. His socks are very fashionable. I encourage you all to check them out after class. Okay, now, what we're going to do is we're going to take the fraction of full capacity. We're going to divide sales by that, and that's going to tell us our full capacity. So I could rearrange that to say full capacity is equal to sales divided by that fraction used. Now, right now we have sales of 1,000. We've been told that is 90% of capacity. When I divide by 0.90, I get 1,111.11111. It just goes on forever. Okay, so what does that mean? It means I can grow my sales up to 1,111.11 without adding any new assets. And so if we expected our sales to only grow 10%, we wouldn't need any new assets at all. So we wouldn't have to worry about going out and getting financing for that stuff. Okay, that's the first step, is to figure out what full capacity is. Then the next step is to figure out what is the percentage increase of our new sales level over full capacity. So how do I figure out a percentage increase? It's new minus old, divide by old, right? That's how I figure that out. Now, it's 1.08 or 108% of the previous, right? And so we're looking at, therefore, a sales growth of an asset growth of 8%. An 8% increase over previous. So, what do I do now? Well, previously I was taking those assets of 500 and multiplying by 1.2. What should I be multiplying by here instead? Yeah, 1.08, because I only need 8% more assets. And when I do that, I get 540 in total assets, not 600. So now my debt plus my equity must also be equal to what number? 540. Everything else works exactly the same. Everything else works exactly the same once we've made this minor adjustment for getting up to full capacity. Now let's talk about the benefits of keeping some slack capacity. What does slack mean?
Meaning you're not using all your capacity.
Yeah, you're not using all your capacity. You've got some room to grow, right? And so when I was running my operation, I tried to run us somewhere between 80 and 90% full capacity. And there are a few reasons why. If I'm running at 100% capacity and I scrap one part, I make one mistake, what does that mean? It means that everything else is going to be late from here till the end of time. By the way, when a customer orders something from you, do you think they have an expected date that they want it by?
Yep.
Absolutely. And when you start pushing out all your orders by a week, you end up pissing off the entire world. Now, what could you do instead? You just tell the very next customer that they're out of luck, right? So instead of pissing off everybody, you're only alienating one. Now, neither of those things are really a good strategic move for you. Here's what you want to do. Keep some slack capacity so when you stumble, you have a chance to recover. Does that make sense? So it's like I'm telling you guys, try to knock it out on the try to knock it out of the park on exam 1. What might happen on exam 2? You might stumble. Would you like a little breathing room? Yeah. By the way, exam 2 is harder than exam 1. Some secret inside information for you there. Okay, recovering from errors. Then we have recovering from breakdowns. I had this machine. It was a Nagata vertical machining center. Total piece of junk. But every single product in my operation depended on that machine. Everything had at least one part that went through that machine. What do you think happened to my ability to ship my product when that machine broke down? I couldn't, right? And so I need to have some opportunity to recover from breakdowns. I had a student who actually I taught in this room. He sat right here. And he went on to do a similar job to what I used to do for Rolls-Royce, not the car maker, the jet engine maker. And he had this vertical turret lathe, which, by the way, I also knew was a piece of junk. We had one in Oklahoma. And he says, man, this thing is just jamming me up. It's constantly breaking down and making it where I can't keep my promises to my customers. And I said, well, can you go out and buy another one? He said, yeah. I said, so here's what you do. You buy another one, you set them side by side, and when one of them's broke down, you shift the work to the other one, right? Does it make sense to have extra capacity like that? By the way, yes, it does. This is also the same as what we're talking about here, maintaining slack capacity. That thing might not be running all the time, but by golly, when you needed it, you're happy to have it. Does that make sense? Okay. And then my favorite, to take on surprise orders. So, back when I'm doing this business, which is it's 25 years ago, let's say. 25 years ago, no, it's more than that. Oh my goodness, I'm old. Okay, so I'm doing this business, and the daily rental rate for rigs in the Gulf of Mexico was $250,000 per day. Now that's just the rental rate on the rig, and it doesn't count all the people on the rig. It doesn't count all the things that are being stacked up behind. So there's all sorts of costs associated if you even lose one day on the rig. Now, I would get calls. By the way, do you think people are perfect? No. Do you think even really sophisticated oil companies occasionally have a planning screw up? Yeah, if you don't believe me, ask the people that live down near the BP horizon, right? The thing blew straight to hell. Okay, now, but the mistakes are usually smaller. And this one is like, no, I forgot to order my valve. That's what I sold, right? I forgot to order my valve. Now, can they complete the well without the valve? No. Federal law says that valve has to be in place before you can complete that well. Now, every day that I can save them saves them at least $250,000. By the way, my product usually sold for around $100,000. If I can save them one day, I could still get by with charging them $350,000, right? That's the break even for them. If I could sell it to them for something less than $350,000, they're still better off, right? And so by having some slack capacity, I could take on those really profitable jobs, right? I would turn that thing around and charge them $500,000 for it. I'm making an extra $400,000. They're thrilled, right? Because our usual lead time was 6 weeks. Does that make sense? And so I want to keep some slack capacity so when these happy things drop in my lap, I can make some money off of them. Do you think it's unethical to charge more for people when they're asking you to jump through hoops? Absolutely not. Here's the trick. Every transaction is an agreement between two people. If they call me up, they're like, hey, my hair's on fire, I forgot to order my valve. And I'm like, $600,000, and they could have said, no. Right? Does that make sense? So don't ever feel bad about trying to capture some of the value that you're creating through your pricing. Questions?
If you have a company that's highly seasonal, would you want to keep the same capacity through each quarter, or do you ramp up as you get into busy season?
It depends on the product. If we're talking about the Christmas candy, which is highly shelf stable, right? You'd be okay to ramp up, or you'd be okay to produce throughout the year. What about turkeys?
You can't keep those year long.
And so in those, you're going to have a lot of slack turkey capacity in some times of the year versus typically Thanksgiving and Christmas are your heavy hitter turkey days, right? Does that make sense? So it really kind of depends on the product. Good questions. Now, here's the big conclusion I want to bring from all this, and that is if we are planning to maintain the same percent slack capacity, then we can do this thing just exactly the same way as we did for maintaining full capacity. Because if you do it the way we did for the first 3 examples, where we assumed full capacity, all that really does is maintain the same proportion of slack capacity. In the original examples, that was 0. But the same is true for 10 or 20%, same is true. So, for the most part, I would recommend that you figure out what percentage of your capacity that you want to keep slack. And therefore, just assume that your assets are going to grow at the same rate as sales once you have achieved that percent slack capacity. By the way, business starts to pick up. You notice your slack capacity starts to do this. As a business manager, what do you need to do? Yeah, start investing in some new capacity, right? Because what's going to happen when eventually it crosses over? Now you're in a world of hurt and you're not able to meet your customers' needs. By the way, humans are creatures of habit. Do you guys agree with that? I mean, you guys are sitting in the same seats that you've been sitting in since day one, for the most part. Do you think that I will habitually order the same thing until something happens? Yeah. There was this pizza that my wife and I loved, DiGiorno Pizzeria Pepperoni. It was really good. And I would have just kept buying that, but they stopped making it. Now, at this point, you probably think, I'm just going to choose another DiGiorno pizza. But you know what? DiGiorno, you've now opened me up to be willing to try other pizzas. And lo and behold, the Tombstone pepperoni pizza is better and cheaper, right? Do you think I'm going to go back to DiGiorno? Even if they bring back pizzeria? No. Does that make sense? So I don't want to give my customers an excuse to look for other suppliers. Okay, so let's talk about, this is it's not so much an equation as it is a method. Number one, we are going to forecast that sales growth, and we are going to increase the sales and cost by the same proportion. That assumption is that the profit margin stays the same. That's the assumption that we're making there. Number two, we're going to note our capacity utilization and our constraints like dividend payout policy and capital structure policy. That capacity utilization, depending on our assumptions, will help determine how much we need in new assets. And then those other constraints will help us to determine where that external financing is going to have to come from. By the way, what is capital structure policy? Go ahead.
How to finance assets between debt and equity.
Yeah, let's look, we need money. How much are we wanting to have in debt? How much are we wanting to have in equity? Do you remember that common debt or constant debt to equity ratio assumption that I threw at you? That is capital structure policy. And by the way, that is a common capital structure policy. And the reason is that we know if within a given industry there is an optimal capital structure. If I am at that optimal capital structure, I very definitely want to maintain that constant debt to equity ratio. Okay, so now we're going to determine how much new equity comes from addition to retained earnings. How do I do that? Well, I start with my net income, and then I subtract out the dividends. And we could know the dividends either from the dividend payout ratio, or they just give us a set amount of dividends that we've got to pay. And so now that we've got that addition to retained earnings, we're going to add that on to our existing equity. And that's going to tell us what our new equity using internal is going to look like. Now at that point, I'm going to see how short I am. So for instance, we had the 250 plus 40 gave us 290 in equity. We know we need 600 overall. That means I need 310 overall. I've only got 250 out there in debt. So how much extra do I have to go out there and get? Well, I've got to go out there and get 50 in debt and 10 in equity. And that's what number 6 is. So this is the method. Should this be on your note sheet? Hopefully you can crunch it down. Now, if you know how to write in Chinese or Japanese or Korean, you have an advantage. Does anyone know why? Why?
Because everything's condensed and you can also quick-hand it.
Yeah, so everything's condensed. One word is one character. Now, it makes it hell to make a Chinese typewriter, but it makes it a lot easier to make your note sheets. Do I mind if you write your note sheet in Chinese? Absolutely not. And by the way, that offer's available to all of you. If you want to write your note sheet in Chinese, feel free. Questions? Okay, now let's talk about EFN and growth. We're going to talk about 2 growth rates here. We're going to talk about the internal growth rate, or IGR. And the internal growth rate just tells us how fast the company can grow on internal equity. So the only money that we have to invest in new assets comes from internal equity, and the internal equity comes from our addition to retained earnings. And then we have the sustainable growth rate. The sustainable growth rate assumes that we are running only on internal equity and enough additional debt to maintain the constant debt to equity ratio. Remember, I told you that that's a common capital structure policy because once you hit your optimal capital structure, you want to maintain it. And so when I grow the business, if I'm already 50-50 debt and equity, I want to finance my new assets with half debt and half equity. And so if I didn't do that, I would be constantly growing the amount of equity versus debt. So we're pushing that debt to equity ratio down. That's not good if we're already at the optimal. Okay, so let's put some formulas to this. IGR stands for internal growth rate. What does ROA stand for? Return on assets. And you see it in two places here. And then we have something else called little b. Little b. Little b has two names, by the way. Up here I put it as plowback ratio. It's also called the retention ratio. By the way, the retention ratio is 1 minus the payout ratio. Here's why. If I divide all of these things by net income, what is this? That's the payout ratio. And so, and what happens to this thing? 1. And so our addition to retained earnings is simply 1 minus, our retention retention ratio is simply 1 minus dividend payout ratio. They always have to add to 1. They always have to add to 1. Okay, now here's where you need to be careful. Do you think sometimes I will give you the plowback ratio? Yes. Do you think sometimes I will give you the dividend payout ratio? Yes. If I give you the dividend payout ratio, what must you do? 1 minus that thing to get B. What do you think the most common mistake is for students on these problems?
They use it as average.
Yeah, they just use the dividend payout ratio. They don't use the retention ratio, so be careful. Okay, so we know why it's the retention ratio because it's retained earnings. Can anyone tell me why it's called the plowback ratio?
It's like harvesting, but when you basically finish harvesting, you have some leftover, you plow it back in the dirt so you can refertilize and grow again.
I'm going to run out of challenge points for you.
Yeah.
Yeah, okay, here we go. Okay, now, did you grow up in a farming area?
No, I just have friends that
No, he's just smart. Okay. Yeah, okay, so I grew up on a farm. And we would harvest the crops. And then the old way was after you harvest the crops, there's still a lot of stuff left in the field. You know, you want the wheat, but do you want the stubble that's left? You bale the straw, and then the stubble that's left, what do? You plow it back into the ground. And that stuff that we're plowing back in, what does it do? It fertilizes the ground for future growth, right? And what are we doing here with the money that we're retaining in the firm? We're plowing it back into the firm to support future growth. That's why it's called the plowback ratio. Okay. Any questions so far? When you're calculating this, I would tell you in your calculator, the first thing to do is to take ROA times B. And I would store that in location 1. And the reason I'm telling you to do that is because it shows up in the problem twice, right? It's on the top, it's on the bottom. So here's what I would do. I would then say recall 1, divide by, open parentheses, 1 minus, recall 1, close parentheses, equal. There are other ways to go about this, but that's the general idea. If you type this thing into your calculator twice, I can almost guarantee you're going to get the problem wrong. And that's just the frailty of humanity, right? We're not perfect. So figure out this simple thing, store it in location 1. By the way, on your TI BA 2+, how do we store something in location 1? Stow 1. Stow 1, right? And how do we pull that number back up? Yeah, RCL 1, recall 1. By the way, how many drawers are there for you to store numbers in on your TI BA 2+? Actually 10, because you could store in 0. Questions? Okay, now let's talk about the sustainable growth rate, or SGR. The formula looks a whole lot the same. What's the only difference? Yeah, it's return on equity instead of return on assets. And we mentioned last time that return on equity is simply return on assets multiplied by something. What is it? Yeah, the equity multiplier. And by the way, what's another way to find the equity multiplier? 1 plus. Come on, guys. This is definitely going to be on the exam. 1 plus what?
Total asset divided by.
Oh, swing and a miss. It's 1 plus the debt to equity ratio. It's 1 plus the debt to equity ratio. So that's your equity multiplier. It's also, as I think this is what she was saying, it's total assets over total equity. Is that what you were saying? Yeah, okay. Okay, now, what does this mean? It means the capital structure is going to be impacting the sustainable growth number, but it's not going to be impacting our internal growth rate number. The more debt I have in my capital structure, the greater the difference between ROE and ROA. If I have no debt in my capital structure, what's the relationship between these two things? They're the same, right? Because 1 plus 0 over something is just 1. And so my equity multiplier will be 1. ROE is going to be equal to ROA. What does that mean about the relationship between IGR and SGR for all equity firms? Yeah, they're exactly the same. However, let's assume that we have $1 of debt for every $1 of equity. Now I can go out there, and if I have $1 of addition to retained earnings, under IGR I would only be able to grow the assets by $1. But under sustainable growth rate, I'm going to have that $1 in equity plus $1 of debt. So I could actually grow the company basically twice as fast. Does that make sense? I can grow those assets twice as fast with using the sustainable growth rate idea rather than the internal growth rate idea. Okay. Now let's talk about what impacts these things. And I'm going to write up something up here that you guys should hopefully remember. And it's that ROE is equal to ROA times the equity multiplier is equal to, ROA is profit margin times total asset turnover. And then we're going to multiply all that by the equity multiplier. So these two things together are ROA. If I do internal growth rate, things that are going to be impacted are going to be things that the profit margin and total asset turnover get impacted by. So profit margin is going to impact both of these because it's going to increase ROA and ROE. And the total asset turnover is going to impact both of them because it impacts both ROA and ROE. The dividend policy is going to impact both of them. Where do we see dividend policy showing up in these equations?
Addition to retained earnings.
Yeah, so it's addition to retained earnings. The dividend policy determines how much money we have left over, which determines what ratio? It's either going to be retention or plowback, depending on what you like to talk about. It's a little b, right? And the lower your dividend payout ratio is, the higher your retention ratio is, the faster both these growth rates are. Does that make sense? Because the more of my earnings that I retain, the more I can grow under both scenarios. There's only one thing that just affects one, and that is financial policy or the capital structure. And that's because it's going to affect SGR only because equity multiplier does not come into play when we're just looking at ROA, right? That's just profit margin times total asset turnover. This capital structure policy is going to impact our equity multiplier. And so the more debt I have in my capital structure, the greater this distance between sustainable growth rate and internal growth rate will be. So for a bank, the sustainable growth rate could be really big, right? Because they've got probably 9 in debt for every 1 of equity. So their equity multiplier would be something like 10. Does that make sense? Okay, now, here's a question. Can I grow a firm faster than the sustainable growth rate while maintaining a constant debt to equity ratio? Your first instinct is to say no. But remember that we have also the ability to raise external equity, right? And so if I'm finding myself in a situation where I'm going to be growing the firm faster than the sustainable growth rate, the right thing for me to do would be to go out there and issue additional equity, and of course debt too, right? To maintain that constant debt to equity ratio as I grow. And in fact, we see that is the big reason for companies to go public, right? Because they need that money to fund that growth, and they are growing faster than the sustainable growth rate. Does that make sense? Okay, any questions about those rates? Okay, so conclusion here. This stuff is hard. Watch this lecture again. Follow the bouncing ball as we go through the examples. I guarantee you that you didn't pick up on everything. Okay, now we have a chance to start talking about Chapter 2. I am very excited that we're having this opportunity. And I promise I won't hold you past 12:15. Yes?
When we compute the payout ratio, do we want to put preferred and common stock dividends or only?
Okay, so what we want to do is to do both preferred and common dividends, because that is actually money flowing out of the firm. So that's a good question. He says, are we talking both preferred and common dividends? The answer is yes. Because if I make 200 in net income and I pay out 80 in common dividends and 20 in preferred, I still only have 100 left over. Excellent question. Other questions? Okay, so let's talk about the balance sheet. The balance sheet is a snapshot in time. It's just one picture. It's a picture of the firm's financial condition, unlike the income statement, which we say is more like a videotape that covers an entire period of time, like 1 year or 1 quarter. We all know this equation. I'm not going to bother you with it. Let's walk through the balance sheet, just for those of you who have forgotten what you know. First of all, we have on this side, we have assets. Over here, we have liabilities and owner's equity. So you see that formula for the balance sheet actually represented graphically here. We have assets equal liability plus owner's equity. And we know that the totals have to be the same on both sides, or it's not a balance sheet. The second thing that you need to notice here is that we have 2 years worth of data. So we're able to look at year-to-year changes. The assets are broken down into 2 groups, current assets and fixed assets. What are current assets? Stuff we expect to turn into cash within 1 year. And so they are listed in descending order of liquidity. Descending order of liquidity. If something is liquid, it means I can turn it into cash at or near the full market value in a very short amount of time. So by definition, cash is the most liquid thing you can have, because cash is already cash. It's at its full market value, and you don't have to wait any time. Now, cash equivalents. Maybe you've got a checking account. So you could write a check for something, and you're good to go. So that's the most liquid thing we've got. Then we have accounts receivable. By the way, what are accounts receivable? What do they represent?
Money that's gonna get paid back to you.
Yeah, money that people owe us, right? Money that our customers owe to us. Now, why is that not as liquid as cash and equivalents?
Because you don't
You
know.
gotta pay you.
Yeah, so here's the deal with the accounts receivable. I've either got to wait 30, 60, or 90 days, whatever I tell them, to get the full value. Or I could sell those receivables to someone else, but only at a discount. Right? Did you guys know you can sell receivables to someone else, but you have to sell it at a discount? Yeah, so you can't have both. So therefore, these things, you can either have full market value, or you can get it quickly, but you can't do both. So accounts receivable, not as liquid as cash and equivalents. Inventory is even less liquid, and here's why. First of all, I got to sell that stuff. Is there any guarantee that I'm going to be able to sell it? No. Secondly, I'm going to sell it on accounts receivable, then I've got to wait 30, 60, 90 days to collect that money. By the way, is it guaranteed that your customers will pay you back? No. That's why we have this allowance for bad debts that you see on financial statements. That's why. And then finally, once we receive that accounts receivable, then we have cash. So it's the least liquid of the current assets we see up there. Then we have, down below, we've got our fixed assets. The big one is plant, property, and equipment. So we're looking at land, we're looking at buildings, we're looking at machinery, that sort of stuff. Headquarters building would also be in property, plant, and equipment. Remember that things are recorded on the balance sheet at historic cost. If you add together all the initial purchase prices of all this stuff, it would be that line that's on top. But then what do we start doing? We start depreciating. And that depreciation builds up over time. And so we have that in accumulated depreciation. And so if you look here, you can see going from 2013 to 2014, depreciation went up by 90. We could go and look at our income statement and see that that is not a coincidence, because it actually says 90 in depreciation expenses. Now, if I take the historical cost minus the accumulated depreciation, that gives me the book value for the assets. And that's what that line, net property, plant, and equipment is. That is the book value of our property, plant, and equipment. Then we have intangible assets. What are intangible assets?
Patents or trademarks.
Yeah, patents, trademarks, goodwill. You guys know about goodwill? If I pay too much, if I pay over the sum of the fair market value of the assets for a company, and I might because of the brand name or the customer base or something like that, that difference is called goodwill, and it's considered to be an intangible asset. Now, just because something is intangible, which means you cannot touch it, does that mean it's not real? No. My love for my wife is intangible, but it is real. Does that make sense? So, you got intangible. You can't touch it, but it is real. So, for instance, can you sell a patent? Yeah. Can you sell a copyright? Yeah. Can you sell goodwill? You could sell the business that the goodwill came from, and the goodwill would go with it. So those are real assets. Okay, now if I add that net property, plant, and equipment to my intangible assets and others, I get my total fixed assets. On the other side, we have liabilities, and liabilities are broken down into current and long-term. So our current liabilities, the one that we always talk about is accounts payable. Accounts payable, what is that?
What you owe to others.
Yeah, money I owe to suppliers. That's account payable, is money I owe to suppliers. Now, I'm going to tell you that anything that ends with the word payable, you can assume is a current liability. If I have notes payable, that's a current liability. If I have current taxes payable or some stuff like that, that's here too. Okay, the other thing that you'll see that tells you that it's a current liability is if it's got the word accrued in front of it. Accrued wages and taxes. This is money you know you owe but have not yet paid. Accrued wages and taxes, money you know you owe but you haven't paid yet. So that last thing I said about taxes payable, let that go. It would be under accrued wages and taxes. And my accountant, Jack Heffelfinger, would always want me to, if we had a good year, he would want me to accrue the expenses for some tools. I would say, what for? And he would say, well, next year may not be as good, so we can reverse that accrual. By the way, my accountants, one of them's missing today. Is that considered kosher to do that sort of stuff? No, it's called earnings smoothing and earnings management, and it's considered wrong. But a lot of people will use those accruals to cook the books. Now, go ahead.
Is it the same for prepayments? Do you assume that all the prepayments on the other side are current assets?
Yes, so if a prepaid expense, yes, would be a current asset. If I'm remembering my accounting right. By the way, do you know when my last accounting class was? 1996. Okay. Yeah, be sure to ask your accounting professor questions like that, because I would hate to lead you down the wrong path. Okay, now, what about long-term liabilities? Deferred taxes. This one blows people's minds. And the reason we have deferred taxes is because of the modified accelerated cost recovery system. We just did straight line depreciation, so you'd start off here with your initial cost, and you would take this down to zero for book value. The modified accelerated cost recovery system allows you to take greater depreciation earlier in the asset's life and less depreciation later on. That means you pay less taxes now, but more taxes later. When would you rather pay $1 of taxes, now or later? I'd rather pay it later, right? Time value of money. If someone owes me money, I want it now. If I owe someone else money, I want to pay it later. Does that make sense? Now, it's totally legal, but here's the trick. Firms often do their financial statements reporting as if they were doing straight line depreciation, but their taxes are actually being determined by this accelerated depreciation. And that difference goes into deferred taxes. So it's money I know I'm going to have to pay, but I haven't paid yet. So that's the that weirdness did not exist prior to 1986. The big one that we talk about, long-term debt. What does long-term mean in finance and accounting? More than a year. We're talking about bonds. We're talking about loans from banks. Any questions? Okay, we'll start here next time. Bring both your Chapter 2 and Chapter 4 stuff for next time.